Okay, so let's continue on with asset allocation with real-world constraints. Let's talk about behavioral biases. You were probably saying to yourself, man, I could use a little bit more behavioral finance right now. Well, your wish has come true. What we're going to do here is we're going to walk through a few standard behavioral biases, figure out what their implications are on asset allocation, and then think about some of the countermeasures that you can use as the manager to be able to work with that client. Okay, so the first one we're going to deal with is loss aversion, right? That loss aversion is a bias in which investors dislike losses more than they like gains. So I'm going to redraw this graph here. It's been a while since we've thought about this, but if we have a graph of utility here, okay, if I have gains, the gains are concave. Okay, and so look at the slope of this. It's less steeply sloped, right? So we have a low slope here. On the other hand, if I have losses, this line here is very steeply sloped. Let me try that again. There we go. Try that a little more. There we go. Just assume that's a continuous line there. And so what are we saying? That part of the line much more steeply sloped, okay? And so this keeps wanting to disappear on me, but this is steep here. And what that is telling us graphically is that when we have small losses, we take them really to heart. We take a lot more pain from those than we take pleasure from an equivalent amount of gain. So if I were to look at this sort of at the same amount of absolute value here, I take a much bigger loss in this region than I take pleasure from a gain in this region, again, because of the difference in slopes. Well, what that means is that when returns turn negative, investors have a tendency to start acting irrationally. That loss aversion comes in and they want to pull all their money out of equities. We need to sort of coach them against that, right? Investors have a strong temptation to try and alter the asset allocation, okay? So what we need to do, we need to be cognizant of that. We need to hear them, but we need to remind them of a few things. So for example, if we've structured the portfolio to meet certain goals, we've been using goal-based investing, but the first thing you can do is point out and say, look at your retirement plan. Your retirement plan is for 30 years, not for 3 months. So we don't need to worry about that, right? A small decline in a portfolio that has a 30-year time horizon, we don't need to worry about that. You can try and convince them that that's really the perspective that they need to take. And if they had goals that were going to be met in the short run, well, you probably didn't have that money in equities in the first place, right? It was in T-bills, it was in commercial paper, it was in certificates of deposit, whatever, things that aren't going to be impacted by the stock market turning down. And so as a result of you putting that money where it should be, well, then hopefully you're going to be allaying those fears of that client. All right, so just to kind of summarize this point here, let's look at these tables, not only loss aversion, but the ones to come, as an indication that behavioral issues are inescapable. At the end of the day, you are dealing with human beings, regardless of whether it's an individual portfolio or an institutional portfolio. These things are going to crop up from time to time, and so you have to know what the impact is, what the client's going to want to do, and the countermeasures that you need to take to try and keep them on track. Okay, next one, illusion of control. Let's remind ourselves of what that is, a tendency to overestimate our skill set, our ability to control events, all right? So what this means from the client perspective, how this impacts the asset allocation, it means that client is going to want to do more trading. So they have a feeling about a certain stock, a feeling about a certain sector, typically unfounded, but they feel real confident about it. They have an illusion of control about it, and so as a result, they want to do more trading, do more tactical asset allocation. Right? Now we can also see this with managers as well, right? Managers can fall victim to this. They feel on behalf of the client that they should do more trading, do more tactical shifts to try and benefit the portfolio. Well, quite often in both cases, this is a behavioral bias that can actually harm the portfolio rather than help it. So above average use of short selling and leverage, concentrated positions, use of biased risk and return forecasts, all of these things can feed into this idea and reinforce this illusion of control, is that, I need to make these trades because I'm the one that's going to make them work. I'm the one that's going to generate alpha from them. You have an illusion of control over future events. So what are the countermeasures? Well, for you as a manager, it's going to be more about you disciplining yourself, right? Self-calibration. Your times that you've done this in the past, look at your win-loss record. Figure out what trades that you've done in what sectors, what stocks, what markets that have actually paid off, where you actually have a track record of getting a tactical asset allocation alpha, and say, okay, I'm just going to stick with those. These other places where I've meddled and I've tried to gain some alpha and it hasn't worked out, maybe I need to stop doing that. From the client's perspective, well, we can look at the market portfolio derived from the basic CAPM mean variance framework and say that's our starting point, right? If it's a relatively unsophisticated investor, that story may not resonate a whole lot with them, but start out by saying, okay, this is where our beginning point is. And so if we're going to change this allocation, Well, we need to be very smart in doing so, right? It needs to sort of fit our strategic asset allocation. So rather than having that unsophisticated client who somehow thinks that they know the trades to make in order to add value to the portfolio, sort of try and remind them of the game plan and try and sort of steer them away from this need of doing excess trading. Now, again, the client is the boss, so if they say make the trade, well, you can do the best you can. They may still force you to make that trade. Well, in that case, you need to make sure you're documenting that trade, and at the end of the year, end of the period, when you meet with them again, show them their own one-loss record. And again, hopefully that's going to be ammunition to help them get back on track. Okay, next thing, mental accounting. This involves separating assets and liabilities into different buckets based on subjective criteria, as we defined this earlier. So what this means, mental accounting, the way we think about assets and liabilities in different ways, this often leads to a suboptimal asset allocation. For example, maintaining a low interest savings account while paying high interest on a credit card, right? Because we look at those as two different things. We've got a bunch of money sitting in savings earning close to zero. On the other hand, we've got a balance sitting on this credit card. Well, why don't we take some of the money out of savings and pay off that credit card? That client may actually not have thought of that. It may have not occurred to them, or they may view them as such separate things that they don't tie one to the other. Individuals spending their tax refund on luxury goods even when their savings are inadequate, so they don't have enough of a reserve fund. On the other hand, they get a tax refund, and what do? They go on vacation, or they buy a boat or something like that, right? So what's our goal here? What's our countermeasure as a manager? Well, that's where we can reinforce that goal-based investing. If you've told them you don't have enough of a reserve fund, that's a goal that they need to attain. And so ahead of time, you can say, hey, if you get a tax refund this year, we're going to put that into the reserve fund because that's a goal we need to achieve. Next thing, representative bias, also known as recency bias. You overemphasize the importance of the most recent events, right? The event that has scarred you most recently is the one that you remember the most intensely. So what this means is that, we have a tendency to fall victim to this bias and allocate to assets that have done well recently, okay? So stocks did great a year ago, so the unsophisticated client says, we need to load all of our money into stocks. Well, we also know that stocks go through periods of momentum and reversal, and so obviously we don't want to buy at market peaks. We don't want to buy right before that reversal occurs. And so how do we defend against this? What's our countermeasure? We need to have a strong governance policy, a very explicitly stated IPS that leads to our strategic asset allocation, right? Get that client to agree that in the long run, this should be our strategic asset allocation, and we're only going to deviate from that when there are changes to the circumstances of the client, not just because of which way the wind blows in a particular day or year. Next one, framing bias occurs when the way information is presented affects the resulting decision. So you go to a client, you present them a portfolio allocation. You present it to them by talking about the risk first. You may scare them off. You present it to them by only talking about the return first. Well, then they may disregard the risk. Depending upon how you frame that information is going to help frame their reaction to that information. And so the result of that, the implication is that it may bias their decision making. So if we look at, for example, let's say standard deviation, we're using standard deviation, what that means is that we may have a lower risk preference to investors relative to looking at other downside risk measures, such as value at risk, for example, right? It may lead to better decisions in certain situations. So however the way you frame that discussion, depending upon which topic you present first, or within a particular topic, again, talking about risk here, do we talk about standard deviation? Do we talk about variance? Do we talk about value at risk? Do we talk about downside deviation? Whatever the case may be, whichever number we're presenting to them may help frame their impact on the result. At the end of the day, you as the manager know that you're presenting a risk parameter. It may all read the same to you. It may have different impacts on them. So how do we countermeasure that? We want to provide a full range of relevant information. Don't rely on one measure because the client may misinterpret that. So we want to make sure we give them a complete discussion and don't selectively frame using only some pieces of information. Now, that doesn't necessarily mean you need to deluge your client, who may be unsophisticated, with a bunch of econometric data, but you at least need to tell the complete story. If you're focusing on one or two numbers, you need to explain the intuition behind what these numbers are telling you and telling the client, so they get a full understanding of what's going on. Next one, availability bias, occurs when personally experienced or more easily recalled events disproportionately influence decisions. Okay, this sounds a lot like recency bias, right? Representativeness bias. So, again, there's some overlap in some of these definitions. Again, one of our frustrations with behavioral finance. However, this does have some very specific implications for asset allocation. So 2 offshoots of this. Familiarity bias. Familiar or easy to recall events given too much importance. So the story that is very easy to remember is the one that sticks in our mind best. That's just kind of standard psychology. It isn't even necessarily a bias in terms of how we remember it, but if we use that to then inform our actions, then that's where it becomes a bias. Another thing is home bias. We're more familiar with U.S. companies if we're a U.S. resident. We're more familiar with companies in the U.K. if we're a U.K. resident. We're more familiar with Japanese companies if we're a Japanese resident. And so as a result, that means that we're going to have a home bias or have a tendency towards that instead of having proper diversification internationally. So how do we get rid of this? What's our countermeasure? Talk about the value of diversification, start with a global market portfolio, and right from the first stage, give that client the importance of diversifying globally rather than just being focused on one market.